So if you've exhausted, there's no money to take that RMD, then it comes back down to the comment I made earlier about either taking a tenancy and common interest in the property, so you can take a deeded ownership in the property, or you can take a membership interest in the LLC if it's a checkbook IRA. Right? So we covered this one. So we negotiate from the deal's inception with a checkbook in the LLC's name. You need earnest money, you write a check, you go to close on it, you write a check, deed is in the LLC's name. You own the thing, you're working through it, all the income goes into it, all the expenses are paid out, you decide it's time to sell, you list it as you normally would, and if you're the broker, you're listing it on behalf of the LLC, the property sells, all the proceeds from that sale go right back into the LLC, sit there and grow totally tax deferred or tax free if it's a Roth. They sit there until you make the next investment, which could be tomorrow or it could be next year. No time constraint. That's pretty attractive.
So if my wife and I both have Roths,
yes.
My wife and I both have Roths, can we combine
yes.
that in?
So back to the LLC.
That, but we need both
no,
in there.
We have two custodial accounts, one for each of you, and then we'd probably just do one LLC.
Okay.
So you'd have $2,900 plus an additional $430.
Okay.
And each would make a single investment into the LLC, and the LLC would then make all investments. Yeah. Then if one of you gets to the point where you have to take a required minimum distribution, you'd each take a distribution to a pro rata share.
Are Roth distributions the same time frame as regular IRAs?
Same 70 and a half.
Okay.
I mean, one of the advantages that I can see of this is that in a 1031, you've got time constriction. Mm-hmm. And you see a piece of property that you really like to buy, but you can't buy it because you haven't sold this. As long as you've got the funds and the ability within that, it doesn't matter when you sell it, it doesn't matter when you buy it.
Exactly. And you've got the ability to write a check to close it whenever you want if you've got a checkbook IRA. And that's what I was commenting to you earlier about. A couple different, one gentleman was referred in by a couple different brokers. And he'd also heard us on the radio. And the one broker just sort of let it go. And I said, you know, I don't understand. I mean, the first building he bought was a $1.2 million or something like that. He bought it outright. So on the market, you see an opportunity, boom, buy it. So, I mean, if you want loans, you can get it if you want to leverage, but we're talking, there's roughly $4 trillion in IRA money on Wall Street. And it takes us 2 to 4 weeks to put an account together. And then it's there.
I think it's a matter of people understanding this. I mean, to most people, including myself, it's still a little bit complicated. Yeah. Once it's understood, I have to believe that it's going to be used so much more frequently. Well, I've never seen I've never been involved in a transaction, Dave, and I've been doing it for 30 years, where I'm either representing a buyer in a circumstance such as this, or where the seller is described as an IRA LLC.
Well, and you know, and we're doing hundreds of them every year. So most all of those are buying real estate.
Well, the interesting thing you mentioned too is 1031s right now. The rule is you're limited in what you can find available.
That's right.
Well, the 1031 you've got
1031s in 3 years ago were almost solely responsible for very inflated base prices on property exchanges.
Yeah, exactly.
Yeah.
Well, you have to because
supply and demand. They were driving, and they just kept driving the sales rates right.
Yeah. And the cost,
you
even
want
if
it that bad, you pay for it.
Yeah, even if you realized it wasn't a good deal, the cost of not getting it, you're outside the ID period, the cost of not getting it was so great that you're going to pay extra because to hide from the tax.
Saw that hugely in 09, actually just before that.
Yeah.
That's exactly what, just before the crash. That's what
Yeah.
happened.
We have for all cash transactions going through our office right now than we ever have.
Well, who can get the deal done? The cash buyers.
Absolutely. Cash
And I'm wondering if a lot of it is in fact
Well, you're going to see more and more of it. Yeah.
pulling cash out of their retirement accounts and buying property.
Yeah. Why not? You know, the downside of real estate is what? It's hard. It's not. You buy a stock, you sit on it. It goes up or down. You're not doing anything, right? And you're letting the broker do it. I have transactions. Some of these we'll put an account together, and the person ends up unwinding it after a year because what happens is the responsibility of the investment falls on their shoulders. And for people that aren't used to that, especially if they're buying real estate and they're new to it, it's stressful to them. So, you know, in a perfect world, you know, it's going to be a passive investment. You're going to have a professional manager. You're managing that property. That's the way things should be done, really, to make it easy for people. But we've got transactions where, you know, I've got everything from people buying buying dirt or fractional ownership in something big, where they're not doing anything to it, to people that we're putting what's called rollover business startups together. The acronyms are ROBs, where people are creating a new real estate investment company that employs them to make investments. So we've got the whole spectrum, depending on what they're trying to do. And you're saying, well, gee, that's what you just said is contrary to what you were saying earlier with respect to prohibited transactions. And it is, but it's a whole different strategy. That's a whole other class you get to come to later. But anyway, we deal with a broad spectrum of things, depending on what people are wanting to do. You know, we talked briefly about 401ks. We talked about IRAs, you know, Roth traditionals, broached, you know, SEP IRAs. Well, they're all different things, different contribution rates, different, little bit tweaked rules, but different things for different people's intentions. Passive investments, basic accounts, great. Active investments, probably checkbook. Income investments, we're going to do the ROBs. You know, so depending on what people want to do. But the idea is the only dumb question is the one that you don't ask. So you have somebody that wants to do something, or you're thinking, hey, can't so-and-so do this? Call it fast, and then we'll go through it. But, you know, I sit in here, and we've got clients. I commented yesterday, the number of clients that we have that these days seem to be very, very intimately acquainted to judges because of all the time they're spending in court with tenants. You know, and that starts making commercial, industrial stuff looking a lot more attractive. And you look at some of the, you know, the triple net stuff, you go buy a Walgreens or whatever it might be, I can see, you know, where those things are attractive too. But the thing that scares me to death about those is, you know, Walgreens has done a huge expansion. They're looking great right now. And all of a sudden, look at Blockbuster. Imagine if you own a Blockbuster store. You know, what do you do? Yes.
Could you take money from your standard Roth and convert it and have a custodian and then lend that out as a private money limit?
Yep. Yeah. So, anything the law allows. So, the only things the law does not allow, collectibles, life insurance contracts, stock and subchapter S. So, as long as you're not transacting with a disqualified party, you can do it. Or you're personally going to benefit from it.
I mean, is there any way, I mean, what if you buy a corporation?
It's fine.
What if you work for that corporation?
Well, that's a Roth. That's a rollover business startup.
So that is...
So we can create, so to answer your question, what we would do if you said, gee, I want to go buy this company,
Right.
and I want to work there.
Right.
We're going to create a new 401k plan. We're going to roll your money. Your money's probably gone from a 401 into an IRA today.
Yes, that's right.
We would then roll that IRA into a new 401k plan. We'd create a new C corporation. The plan would then make an investment in the C corporation, which would then employ you. And now you've got a new job, a new business.
What if I have an
It's owned by your
What if I have an S corp right now?
Can't use it.
I can't use it at all.
If you have a business, okay, so the question is, what happened? I've got a business today, it's thriving, but I want more. I've got a guy down in Albany right now, he's got a business, it's been going well, it's great, but he's got $500,000 in his retirement account, he wants to buy a new facility, and he wants to occupy that. We can't use an IRA to do that, because if we do that, now we've got a lease agreement, he's occupying a building that's owned by his retirement plan, prohibited transaction. So what we end up doing is creating a new corporation that he contributes his current business to, and the $500,000 comes in from his plan, and this new co now owns the property, the business, and everything.
Now you got complicated.
It just sounds like a giant
Okay,
shocking.
right.
I mean, you're just tell Dave what you tell Dave what you want to do, and he'll figure it out.
Yeah. I mean, and so, the thing is, we've had transactions over the last few years where, I had one guy come in that had a property that, $3 million piece of dirt, $1.2 million lien on it. The lien was with Sterling Bank. He was concerned the bank was going to go away. If the bank went away, he was going to lose the property. He wasn't totally current on it. So his dad had $1.8 million in it in his retirement account. He wanted to use Dad's account to do a checkbook and wanted to use Dad's to pay the bank off. Can't do that. Prohibited transaction, right? So what we ended up doing is creating a new limited liability. So we did checkbook IRA for Dad. We did a second limited liability company. The son contributed the property, received membership interest attributable to his equity. Simultaneously, Dad's checkbook IRA wrote a check in, receiving interest attributable to cash contribution. Who owns the property now? New LLC. The LLC then paid the bank off.
So maybe I'm getting silly here.
Yeah.
So
John's just
I can't.
rubbing his head.
There's a lot of moving parts.
Yeah.
If I wanted to go start up a new business,
Yes.
say senior services,
Yes.
could I use one of my IRAs or Roth
Yes.
or whatever?
As long as it
do
was
that,
not,
do that rollover business.
as long as it
startup?
was not inherited, yes.
Right. No, this would be
Yeah.
something start from scratch and just go out. We're going to start.
Yeah, but your
business.
plans are not inherited. Your IRAs were not inherited.
Okay.
Yeah.
Right.
Then we could, yes.
As long as it was. No, I do. Tammy does have.
It's a brand new company. It's fine. So, for example, there's right across the lobby here. And I don't know what the franchise is. New pet shops or something, and it's not Petco.
You buy a franchise.
Yeah, you buy franchise. You go to a franchise forum these days or conference. A lot of those franchises sell franchises to people that are buying those with their retirement accounts.
So that would really
SBA money's
that would be
not really there right
a
now.
good
so.
use for a Roth, probably.
Well, yeah, Ron. I mean, Penskill, one of the big custodians, tells a story of somebody in the tech world that started a tech company with $1,800. Ended up selling it for in excess of $1 billion. It was started with a Roth.
So are you saying when he sold it, it was tax-free?
Yes.
Wow.
Whoa.
All
I mean,
right.
that doesn't happen every day, guys.
No, it doesn't.
You don't do a lot of those.
Yeah.
But whether they started with a Roth or not.
That's right. Okay, so this page, we hit the solo 401ks a little bit. And actually, we've already talked about this. The reason I like the solo 401ks is you can make Roth contributions, increase annual contributions, no UBIT on leveraged real estate, no custodian required, can invest in life insurance and S Corp stock, borrow. The other thing I didn't mention is you can borrow against a 401k plan. 50% of what's in it up to $50,000. The downside, you've got a 5,500 form, 5,500 easy for under $250,000 worth of assets. More than $250,000, you've got a full-blown 5,500. Maybe it costs you $500 a year for that. And then you've got the maintenance of the plan, which typically is going to be, let's say, $300 to $700 a year to maintain the plan. So, there's advantages to that. The downside's typically the cost. How do we do those? Those are self-trustee typically. So all we do is put a new plan together. As soon as we put the plan together, you go to the bank, open an account in the plan's name, the plan's federal tax ID number. You then move the money from your current IRA or 401k plan into that plan. And then to make an investment, you write a check. You just sign on that account. You're the trustee of the plan. So they're pretty neat. This is the rollover business startup that you asked about. This is how we do it. We just create the new plan, create the new corp, and it's got to be a C corp, unfortunately. So you've got additional taxation, you've got payroll deduction, you've got different issues there. So it's not all beautiful. But that's the way people are getting deals done,
But I
buying
can,
businesses.
but I can draw a salary from it.
Correct. Yeah. So we've done gas stations, we've done convenience stores, mattress companies, did a mining company in Eastern Oregon, just finished a computer tech company, all kinds of different things. Done a lot of real estate investment companies this way. So, getting around that sweat equity piece, and with an IRA you can't work on it. A Rob's, roll of business startup, we just do this new investment real estate company. You can be employed by it, you can work on it, and do whatever you want. Gotta have a good bookkeeper. But we're doing a lot of that. I hear all these people talking about SBA money. I don't see the SBA money flowing out the gates too quickly, and this is where people are saying, gee, I lost my job, I need to do something. This is an opportunity for me to go forward and make a difference. And that's what they want to do. That's how they do it. So, some examples, then we're out of here. This guy came in and actually he handles our advertising. So I'm trying to figure out if he just did it because he wanted our business or I'm just kidding. He's a good friend, but he came in. He was an early customer, and he came in. He had a buddy that had a subdivision that was having some problems and needed some money and wanted to sell some stuff. So he said, "Hey, this is an opportunity to help my friend, and also I'd be buying something I believe is going to be worth some good money in the future." And the thing you need to understand is that, IRA money is different than money out of your pocket. Typically, people pull money out of their pocket, you need that return right away. If you bought a tick investment and you're used to getting a check monthly and all of a sudden you don't get it, you're feeling it today. IRA money, 401k money is patient money. I mean, you're not going to use it, you can't touch it until you start taking it as distribution. So for him, he said, look, these lots, I don't care if they go up in the next 5 years, 10 years, I'm not going to touch them for 10 probably anyway. So that's what I'm concerned about. I know they won't go away. They might go up, down a little bit, but I know 10 years from now they're going to be a good spot. So he rolled enough money to make that investment, and then started working through some other stuff, started talking around, and found one of these other companies we do a lot of work with had a student housing project up in Boise that they got involved with, and it was tied in with BYU. And I guess this project, some of the projects are set up in a way where the university withhold a diploma until the student is current on their rents. And this particular project, they get $300 a bed, 2 beds a bedroom. And he just thought, this is great, it's a no-brainer. And so he ended up converting another chunk of money, and ended up buying a 10-cent common ownership in this large passive investment for him. And he's just thrilled to death with what's going on there. He's got some good diversification. Now he's looking at doing some other things. So, your question about all or nothing, in his case, he got his feet wet, he's slowly moving stuff through, and he does it as he chooses. So in that first one, he was sort of helping a buddy out too. This example, this gal came in, she was in one of the classes, a real estate broker, and my second slide, or actually the first slide inside, said what? Recession investing requires you solve someone's problem. The first one solves someone's problem. This one, gal was a broker, came to class, loved what was going on, said, hey, I can do better, I want to invest in what I know, so she set up the account. First property she bought was a property from a developer that run out of money, and it was the example I gave you earlier. Thing couldn't be sold. Kitchen wasn't done. Bathrooms weren't done. So she set up a side agreement. She says, look, if you will sell it to me at this price, we'll get this thing finished, and I'll give you a third of what my net profit is. So she bought it. 4 months later, it was all done. She got it sold, made $150,000, wrote a check back to that original owner for $50,000. So it solved his problem. Ended up a great thing for that builder, and a great thing for her. She was thrilled.
And she didn't have any sort of time constraints, having to reinvest.
None.
That's what I like about it.
Yeah. This was a more complicated transaction that people came in. Guy wanted to buy a property that ultimately was going to be his home. To buy that property, he had to buy the adjacent property, which he didn't have enough to buy outside. So what he ended up doing is, and he and this other gal, we ended up setting up a couple of solo 401ks, one for each of them, and then self-directed IRA also. But he ended up getting set up. He had to get both because it was, like I said, that bulk deal that had to be done. And so he ended up loaning his money to this other gal that bought the adjacent parcel. They ended up doing some things, lot line adjustments, taking care of an easement, and then they ended up spinning off the other adjacent property. And at least last I heard, they were getting married. So in their situation, think about it. So he loaned her the money to go do all this stuff, which was all fine today. As soon as they're married, no more. I've got another client right now that we're setting up accounts for, and his daughter's boyfriend's a builder, and they're talking about getting married. I said, well, fine, he can do stuff today. He can do the work. He can do all these things today. But as soon as he gets married, you got to stop. You're done with this stuff. The rules change. So, that's once again being diligent and understanding what you can and can't do and taking care of it. But this was, an aggregation of those different accounts to get the deal done. Think of this. 1031s, seller financing in a tax-deferred exchange is cumbersome. You can do it. A lot of people think you can't. But you can sell and carry paper, but we have to do something with that note. So when the property sells, the cash comes into us, the note comes into us. Think about this. You could sell a property that was yours to a buyer that you've qualified. That note is now ours. Could you take your retirement account to buy that note? Yes. It's not a prohibited transaction because we're not a disqualified party to you. So if the note's paying 7 or 8%, and you got the money sitting in the bank paying you 1.1, you'd be thrilled. Is that an opportunity? So you can get deals to happen. You can make deals happen by doing that type of transaction. We've got three elderly gals that just like to buy properties. And they've got a gentleman that does all the work, coordinates everything, and they just, it's a hobby to them. But they were paying hard money rates for the money to do these things. What are they doing? They're converting retirement accounts. And in their situation, it's sort of a unique thing. They haven't decided which way to go yet, but they've got a choice because each of them, we could do a single LLC that all three are a member of, and each of them could have a self-directed IRA that loaned money directly to that entity, and then they could work on it all because at 33% owners, that entity is not a disqualified party to them. So instead of having the plan directly own the assets, which would preclude them from doing any work or doing anything on it, they could actually loan money to this LLC that then does everything. Or they can just each have, since they're really not working anyway, they haven't decided which way they're going to go yet. If we just have self-directed IRAs each buy the assets and do it that way. I think it's honestly a better situation for them to loan money to the other entity. This guy's great. He's a lot of fun. He came into us. He had institutional medical practice. So large companies he'd go and set up clinics for. And he retired. He came in and he got called in, sent in to us by a broker, and he was interested in buying a mobile home RV park. And he said, well, Dave, can I do this? And I said, yeah, sure, Leroy, you can do this, do that. And he said, do you want me to send you any information on it? He lives down in Monterey Country Club down in the desert, has a boat, nice big boat in the islands, has a place in Hawaii, a place in Texas, and he's just always bouncing around and has a great life. And I said, Leroy, out of curiosity, what's your objective here? He says, well, my kids are like around 50 and I just want to retire them and play. And I said, well, I can be adopted. I'd be happy to do that with you. You look like you got things going on pretty well. But, so he called up, I asked him, I said, do you want me to send any information? No, that's all right. I'll come, stop by on the way up the boat. I said, okay, that's fine. Calls up the next morning. can I buy paper? I said, sure, you can buy paper. Okay, great. Okay, I'll see you in a few weeks. Calls up that afternoon. I want to do it. Okay. So, back to my comment earlier, 1031 is what happens these days. We don't have a deal. People call up, oh, can I do this, can I do that? And we won't see it until they've got a place to go. Money just doesn't sit here that often anymore. This world, what happens is people call up and they say, well, can I do this, can I do that? And we won't hear anything from them until they have a place to go, until they've got that thing figured out. It takes 2 to 4 weeks to get it done. The fastest we've done it's probably a business week, but I discourage you from doing that, especially if you're writing an offer, because you need time. You need to get the earnest money. So better to get things set sooner rather than later. But in this situation, he was like, oh, patient, not going to do anything else, and boom, I want to do this. So all he did was he came in and he wanted to, the first thing he wanted to buy was this note, paying 11%. 50% loan to value on a $70,000 property that pre-market collapse had been $250,000. So my advice anytime you're buying paper is never pay any more for the paper than you'd be happy owning the property for, and never buy a second. So in his situation, he said, Dave, the worst thing that could ever happen to me is for this person to, go term on this thing. Because he was looking at it and say, gee, after legal costs, maybe I paid $40,000 for this condo. I'd love that. But he had a broker he's worked with. He, the terrible tease, toils, trash, tons, turnover, didn't want to deal with the stuff. So he just kept doing this, and he slowly, back to your question of funding over time. He's moved, I think, $1.8 million to us. Buying notes. Every time he goes to buy another note, he moves more money. And the worst he's getting paid is, I think, that actually maybe he's got one that's paying like 9%. 9 to 16 or so is the range, nothing more than 50% loan to value. He's the happiest guy in the world. He loves real estate anyway, so for him it's just, more. But notes, first he loves them because he doesn't have to do a thing with them. He's got a broker that he works with, takes care of everything. If there's a default, the broker takes care of all for him. But he's a neat guy. He's just a character. When he comes through town, he always stops in and says hi. So this sort of, actually this isn't the one, the next one's the one I want to give. This is a builder, sort of that disqualified deal. So we're about done, we're running out of time. In this situation, builder wanted land bank, uses retirement account to land bank. So what he do is, we did a checkbook IRA for him. We also did a second LLC. Actually, we didn't do it. He had another LLC that he's 1/6 owner in. So his checkbook IRA went out, goes out, buys the dirt, and then as he wants to build it out with his other LLC that he's a 1/6 owner of, so it's no longer a disqualified or prohibited transaction between disqualified parties, the other entity will build it out, sell it, and go buy more dirt from him. So we can move things through, and he just keeps buying more dirt. It has it set, so he doesn't have to pay the bank for it. These people came in, once again, mobile home RV park. This is the last example. They came and said, look, can I take my money and we want to go buy this mobile home RV park? We said, sure, you can do that. Did we mention we want to live there and we want to manage it? No, you didn't mention that. Well, you can't do that with an IRA, so we did the rollover business startup. So we created a new 401k plan, moved all the money in the new plan, created a new C Corp, funded the C Corp then went and bought the property that they are paid as the on-site managers. So they bought the park, made the investment they wanted to make, bought themselves a job and a place to live. Plan ahead. It takes 2 to 4 weeks to establish your account. You can use all kinds of, you can purchase all types of property with an IRA, SEP IRA, Roth IRA, purchase with family members and friends, cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage, negotiate from the deal's inception in the IRA or IRA LLC's name. Don't overextend. Plan on keeping a nice cushion for reserves. Real estate is real investment. And this page just talks about different services we offer. IRA Advantage for self-directed retirement accounts, Equity Advantage for tax-deferred exchanges. Then we've got this bottom of the property listing sites. Post 1031 is free for anyone to register. Sort of works like vertical email. If you sign up for that type of thing, it'll kick it out. But it was sort of my frustration over one of we'll leave nameless, large online listing companies that I could not for the life of me find my properties on. So we put that company together, that site together just for our clients. We had a lot of brokers and clients come to us all the time. Is there a place? I can find this as a place to post? Can I get my property in front of your clients? And this was a response to all that. It's got a section on housing wants too that I like. So if you don't have control of something, or you've got an idea, you want to buy paper, hey, X dollars would like to do this or that. So take a look at that.
Can we post a listing with you?
Certainly.
Yeah. Commercial?
Yep.
No problem.
Yeah, take a look at it. Check it out. Let me know what you think. But thank you very much for the time today.
Thank you very much.
And I hope it was